This, in my opinion, is the best Vanguard index fund portfolio out there. The index funds that I have chosen in this video will keep you diversified while giving you safe, long-term, consistent gains. I have taken into account performance history, annual fees, safety, and diversification when picking these index funds. In this video, I will go over each index fund in depth and give you my opinion on how much of your portfolio should be allocated to each of these index funds. The first index fund that I'm going to talk about is VTSAX, also known as the Vanguard Total Stock Market Index Fund. This ETF is a collection of all the stocks in the US stock market. This means that you are extremely diversified with pretty even distribution into each sector of the economy. In this fund, you have a pretty even mix of the large cap, the mid cap, and the small cap stocks. And that is because it covers every single stock. One quick thing to note about VTSAX is 26% of the stocks in VTSAX are in the tech sector. This means that you will have high exposure to the rapid growth that's been happening in the tech sector over the last couple of years, but it could also mean that you have high exposure if the tech sector were to go down. This means more volatility. If tech were to have a bad day, let's say a really bad day, you would most likely see VTSAX going down 3 to 5%. For an index fund, that is a pretty big move. Personally, I think that the tech sector is going to do very well over the next 10 to 20 years, but if you do not believe in the tech sector long term, or you are closer to retirement and have a lower risk tolerance, then VTSAX might not be for you. Over the last 30 years, VTSAX has returned 10% year over year. Anything above 7% is considered pretty good, so 10% is a really nice return. The fact that you can get this good of a return while being this diversified is the exact reason why VTSAX is a must-have in my Vanguard portfolio. Over the last 20 years, VTSAX has had a positive return 16 out of 20 times. So this means that the majority of the time, you are going to make money each year. You really do not want an index fund that is negative more than it's positive, so this index fund checks off that box. The annual fund for this fee is very low. Coming in at 0.04% each year, that means that for every $100 you have in VTSAX, you will be paying 4 cents per year. The growth that you get from this fund is 100% worth that minuscule fee. Now, Lyndon, what percentage of my portfolio should be in VTSAX? I recommend if you are under 40 years old that this fund be 40% of your Vanguard portfolio. If you are over 40 years old, then I recommend that this fund be 50% of your Vanguard portfolio. The reason for the split is that when you are young, you can take more risk. VTSAX is generally a very safe investment, so as you get older, it should become a larger part of your portfolio. This fund is not going anywhere, and I would hold on to it for life. The next fund that you should have in your portfolio is VOO, or VOO. VOO is Vanguard's S&P 500 index fund. Hold up, what's the S&P 500? The S&P 500 is a collection of the top 500 companies within the US. This collection changes every now and then as companies rise and fall, but for the most part it stays the same over time. This is because the most successful companies in the US are usually in it for the long run. VOO holds the best companies in the US, so that'll be companies like Amazon, Apple, Tesla, and 497 more. These are the companies that are driving real change and leading our economy. Similar to VTSAX, VOO has about a quarter of its distribution in the tech sector. So again, if you are uncomfortable having that much of your portfolio in the tech sector, then this one might not be for you, but for me, I love tech, so I'm going with it. 85% of the companies in VOO are large cap stocks, while only 15% are mid cap stocks. This makes sense because the top 500 companies in the US are most likely large cap. Because there are only 500 stocks in this index fund, that makes it more volatile than VTSAX. VTSAX, while it can still have some volatility, is much less volatile than VOO, and that's why I said if you are older, then you should allocate more VTSAX in your portfolio than VOO. Yes, VOO is a little more risky, although still, in the grand scheme of things, very, very safe. When you're young, you can afford to take more risk, and more risk equals higher reward. Over the last 10 years, VOO has returned 13% year over year. This is 3% higher than VTSAX's return. Over the last 20 years, VOO was positive 14 out of 20 of those years. Compared to VTSAX's 16 out of 20, this is a little bit less, but it still provided a higher long-term reward because there was a little more risk. So while in the short term it may be a little more volatile than VTSAX, over the long run it is most likely going to give you a higher return than VTSAX. If you are under 40, I recommend you allocate 50 to 60% of your portfolio towards VOO, while if you're over 40, I recommend you allocate 40% of your portfolio towards VOO. When you're younger, you can handle more risk, but when you are older, you are a lot more focused on preserving your already earned money than making a bunch of new money. This is a great ETF to hold for life and will give you great returns over the long run. Oh, and by the way, the annual fee is the exact same as VTSAX. The final index fund to complete your Vanguard portfolio is VXUS or VXXUS. This is Vanguard's International Index Fund. This means that you are tracking the international market instead of the US market. Focusing part of your portfolio on markets outside of the US can protect you from volatility inside the US and also just diversify your portfolio a lot more. VXXUS is mostly comprised of low volatility stocks. This is a mix of large, mid, and small cap stocks. With low volatility and low risk, you sacrifice gains, but the trade-off is you gain safety. The average return over the last 10 years in VXXUS was 5%. Now this return is fairly low, but most of the time you will not see very much volatility in the stock, so again, it's a trade-off for safety. On a very bad day in the markets, the most you'd probably see on VXXUS is a 3% drop. The annual fee on this fund is 0.08%, so double what VTSAX and VU's annual fee was. Even though this fee is double, it is still very minuscule in the long run. If you are under 40, I would only allocate at most 10% of this international index fund into your portfolio, but honestly, I think you'd be better off just going 60% VU and 40% VTSAX and just leaving VXXUS out completely. But if you are over 40, then I would recommend that you put 10 to 20% of your portfolio in VXXUS, and that way you just have some protection in case the US market dips, especially if you're using that money for retirement. So if the market dips and you have to take money out to survive, you can take it out of the international index fund instead of the US index fund while the US one is down. And then once the US index fund recovers, then you can stop taking money out of the international index fund. VXXUS acts as basically a safety net while keeping up with inflation and making you about 2% on top of inflation. Overall, if you are under 40, your portfolio should be 60% VU, 40% VTSAX, 50% VU, 40% VTSAX, 10% VXXUS. And if you are over 40, then your portfolio should probably be 10 to 20% VXXUS and 50% VTSAX and then 40% VU. Thank you all so much for watching. I really hope this video brought you some value and taught you something new about Vanguard index funds. If you want to learn more about personal finance and investing, then I recommend you follow along with this channel by subscribing. If you have any questions about anything in this video, then feel free to comment it down below and I will make sure to answer it. Thank you all and have a great day.